let me start with a really big picture perspective. In some ways, it is not dissimilar to early 2000 in the sense that the overall market looks reasonably expensive. But that's made up of a part that is very expensive and a part that's okay. So unfortunately, in an absolute sense, it's very difficult for me to sit here and say, these value stocks are all going to go up by phenomenal multiples. Because what has really happened is that the value stocks are priced the way they usually are. The other side has been re-rated to very high levels. So from a total index perspective, that is bad news for returns. From a relative basis, though, it is really exciting. Because, it's staggering to think we're here today in March 2000. You look at the ratios across various measures in Australia and the US. Some are past that, some are not quite there, some are at it. We are in March 2000. Now, what happened then was that the growth stocks fell and the value stocks went up a bit, but the difference in the end was absolutely enormous over 3-4 years, right? So in a relative sense, that's really exciting. But in absolute sense, unfortunately, it's really hard to beat the drum and say, there's an opportunity to make absolute dollars, but it's a way of not losing them by being in the stocks that are reasonably valued. And look, it's very interesting because for the last 16, 17 years, I told anybody who wanted to listen, and probably some people who didn't want to listen, that I said I will never see the likes of the tech boom again, right? And the reason I said that was that the tech boom was, in terms of multiple distortions, it was a 1 in 100-year event. So it's rare, right? That was my starting point. That was the worst ever. And my second point was it was a multiple boom. So easy to see. You just look at the multiple, right? In the mining boom, that was much more subtle because the earnings were wrong. The earnings were unsustainable. Much harder to explain to clients why you don't own BHP at $50 because it's only on 12 times. Right? So I thought, look, that was such an obvious bubble. This is not going to happen again. And thirdly, I thought, look, the internet's only young once, and that sort of early promise where everything seems possible, that perhaps only happens once. Well, it's taken 25% of world GDP of stimulus. It's taken day traders. It's taken a pandemic. It's taken lots of unusual things to get us back there, but we're back there. And that's pretty remarkable, isn't it? If I talk about the portfolio, look, we've got a whole eclectic lot of different stocks. We've got various sort of, if you group them, we've got various very defensive stocks, things like Horizon, the regulated railway business in Queensland, Spark Infrastructure, Transurban, Atlas Arteria Roads. And mostly these stocks are only lightly affected, although for the road stocks there was this question of there's a clear benefit from a problem with public transport and people going taken to private motor cars. On the other side, you've got working from home. So there's a bit of a trade-off, but from what we see at the moment in terms of how traffic is recovering, it doesn't seem to have had really very much of an effect. So we've made some allowance in these stocks, but these are very, very defensive names. And if I then sort of look all the way at the opposite end, we've got some what you might call reopening stocks. Small positions in Flight Centre, for example. Flight Centre was a stock we actually owned when the crisis hit. We sold it very quickly for the very high 20s and bought them back at a quarter of the price in the raising when they needed to get their balance sheet fixed. Now has close to $1 billion of cash. They have a year odd to wait until either the pandemic exhausts itself, or we get a vaccine, or they eventually may have to come back to the market. So small position, but obviously enormous upside if and when things return to normal, because the price is still, 15-20% of what it was pre-crisis. So there are a couple of those. Others I'd put into that category are things like the casino stocks. Again, obvious victims in the short term, but in their case, they have a lot of assets. So there's a lot of real estate there and the like. We've got another sort of bucket of stocks that are almost advantaged by the crisis. I'm not here talking about pure online play, but things like Coles and Metcash. And for them, the benefit isn't enormously great, but they actually benefit. And the simple fact is that for the average stock, this is bad news, right? Some really bad, others not so bad. Very few actually end up on the positive side of the ledger. Coles and Metcash do, simply because more groceries flow through the retail channel than through the wholesale channel to restaurants and entertainment venues and so forth. So there's a bit of a benefit there, but it's not, I wouldn't say it's enormous. Other stocks that we have there are, say, Costa, which we bought into because it was really ravaged by the drought. But the droughts eventually end and the stocks start to recover very nicely. They benefit a little bit again from retail margins are better than wholesale. And to some degree, Tassel, the Tasmanian salmon business, a little bit in that category as well, in the sense that the retail channel is much more profitable than the wholesale channel.